Samantha Azzarello, in your view, the Federal Reserve is depressing confidence in the U.S. economy by dithering over interest rates. How much are they depressing the U.S. economy?
I would say substantially. So if we look at how far the U.S. economy has come, it's safe to say that we don't need emergency measures anymore. And by all intents and purposes, 0% interest rates are emergency measures. And I think what we need now is the Fed to raise rates and, to give that vote of confidence to the market that the U.S. economy is on sound footing and ready to keep going.
But now it seems like they're worried about the Chinese economy. You heard that from the language in the statement. How worried are you about the Chinese economy? And should they be looking towards the Chinese economy to determine our interest rates?
I mean, I want to say no, because the Fed has a clearly defined dual mandate, which we're all very aware of: labor market and stable inflation. That being said, to the extent that the Chinese economy affects our labor market or our inflation, the Fed has to be tuned in to what's happening abroad, especially what's happening in China.
Well, things have stabilized in the U.S. stock market since September. We'll see if it flares up again. But is the stock market adequately reflecting what's going on in the U.S. economy? We fairly valued here, undervalued, overvalued. What is it?
I would say fairly valued. I obviously say that keeping in mind there's many valuation metrics you can look at. We personally like forward PEs, and by that measure, the market's fairly valued. Obviously, if you go in a little bit deeper, some pockets are overvalued versus others. That being said, we're overweight stocks over bonds. We still like U.S. equities. We think the expansion has room to run, and earnings growth is steady but stable, and could pick up. Will, in our view, pick up in 2016.
Let's dig a little bit deeper. Which sectors do you like for all those stock pickers out there?
I really like healthcare. And when I think of healthcare in the shorter term now, it's slightly above fair value, I'd say. But to me, healthcare makes sense in the long run. It's like intuitive investing almost. So, we've got baby boomers. We have lots of people getting older. There's lots of advancements in healthcare technology. And when I think that, the Affordable Care Act, or Obamacare, whatever you'd like to call it, didn't end up hurting healthcare returns at all when everyone thought it would, and healthcare took off like a rocket. Still like healthcare. Also, based on where we are in the expansionary cycle, I like consumer discretionary and also like tech.
And then finally, eventually the Fed will have to do something, just to get back to the opening question. Should investors fight the Fed when they finally choose to pull the trigger and raise rates?
Don't fight the Fed. / you can't fight the Fed. The Fed does not want to mess this up, this rate hike cycle, as much as we, the market, don't want them to mess it up. So that's my opinion. They're going to do everything they can to make this as smooth as possible. So in my mind, that means no sharp moves, no fast increases, no surprises. They are going to telegraph to the market what they're going to do, and then they're going to do it slowly and steadily. So in my opinion, for that reason, we could see less volatility in the bond market than everyone's expecting.
All right, well, thanks a lot, Samantha.
Thank you.
And thank you for watching The Street.